All right, my name is Jason Watson with WCG, alongside
Joseph Bassett.
Megan Oeltjenbruns.
All right, and this is segment 4 of our 4-segment podcast on CRNA type stuff. We've been seeing a lot of movement in the CRNA landscape in the last couple of years. A lot of them being converted from W-2s to 1099s. 1099 contractors really are businesses, right? Some people, they leave on a Friday, W-2 employee. They show up on Monday as a contractor. And in their brain, they're like, it's just all the same. I show up, I put people to sleep, and what's the big deal? Well, there's a lot more opportunity for you, and there's a lot more that you have to pay attention to as a contractor. And we talked about, in previous segments, we talked about setting up your entity and all that good stuff, S-election, why it makes sense, when it doesn't, when you maybe want to defer into the following year. In segment 3, we talked about registering in a state to do business in that state. Nothing to do with income taxes or payroll. Those are separate issues, income and payroll. And then also temporary duty assignments as well. So in this one, we're going to talk about tax deductions. We're just going to kind of run through the common ones. There's a zillion. Maybe not a zillion, maybe just short of a million, but a lot. First one's home office. Talk to me about home office, Megan.
Yeah.
How's that work?
So basically it's the idea, and this kind of stretches across a number of different categories, but the big thing with home office is basically you're saying, hey, I have dedicated a piece of my property that I own personally.
Or rent,
to the business, right? And I've committed this space. And so all these expenses that I pay personally, the rent or the mortgage or the property taxes or the house cleaner, whatever it is, have some level of proportionate business use, okay? And so what we're trying to do is capture that if you qualify for home office and all these things, right? So what we're trying to do is say, hey, of my 2,000 square foot house, 10% of it is dedicated to this business. And so I'm going to take 10% of my property tax and my homeowner's insurance and my mortgage interest and all these things, and I'm going to show those on my business tax return as tax deductions.
Yep, absolutely. There's two big advantages. Is if you don't itemize your deductions, that low mortgage interest, that low real estate tax is not deductible anyway. Now we're creating a deduction that wasn't available to you, right? Because it was less than the standard deduction. Tax Cuts and Jobs Act cranked up the standard deduction, right? Yeah. Which is good and bad, but it's mostly good. Home office. Also, because people are like, well, my mortgage interest is already deductible. My real estate taxes are already deductible. And let's say not SALT limited, right, to $10,000. That's cool, you're right. But what a home office does is now open up your commuting doors, right, to more deductions. Without a home office, and this I think blows people away a little bit, without a home office, your drive from your home to your hospital is not tax deductible. That's considered commuting because you're driving to your tax home. But if you're driving to the principal place of business. But if you now have a home office, your commute's from the bedroom to the basement, and then the drive from your home office to the hospital is basically a drive between work locations. So the home office in itself, maybe, I'm not trying to value assess money, but it's maybe $100, $150 cash in pocket from the extra deductions of homeowners insurance or HOA or utilities or all those things you can't deduct on a Schedule A of your tax return. That's good money, but it's not great money. But if you can take all this mileage and take other things associated with that, that's a bigger deal. If you drive 10,000 miles over the course of the year without a home office, you just lost $6,000 in tax deductions. At the highest marginal tax rate, that's $2,200 or so. That's real money, cash in pocket, right? So anyway, the home office I don't think is that great of a deduction in itself. It does open up the doors to more deductions. Anything you want to add to home office?
Yeah, I was just going to say, and some people might not use a home office. They might want to keep their work life and their personal life separate. We get that. But there are still other avenues to use your home as a deduction, right? So for single member S corps that are personal services might not apply to them, them, but the master's rule, right? Where you rent your home to your business for 14,000, is that
14 days.
14 days for fair market value.
Yeah, fair market
Fair
value.
market value for
Let's say $1,000 a night.
yeah, there you go. That's what I was thinking. For 14 days or less, you as the individual don't have to pay tax on that money, and the business takes it as a deduction.
Yeah.
Now, it's going to apply more if you have employees, or I think we had a client once that had Tupperware parties.
Pampered chef.
Pampered chefs, where she just rented out the basement of her home, and now maybe
Once a month.
Yeah, once a month.
Well, the argument there was that if she didn't rent out her house for these events, she would have had to rent out a separate space. So
Exactly.
something
Yeah.
was going to get rented.
Yeah.
It was, if she does it internally, she's got a deduction with no corresponding income.
Where it gets a little bit thin is when someone says, "Oh, I got board meetings at my house once a month." I'm like, "Well, who's on the board?" First of all, you're an LLC. You don't have a board of directors, but let's just pretend like you do. Well, it's just me. Okay, what business purpose is this serving? So, and you get people who get advice from their bartender or from their produce clerk or from whoever, and they're like, "Well, you can create this. You can do board meetings at your house and have this deduction that doesn't count as your income and all these things." And you're like, "Well, yes, technically, practically, it's an end around. People will see right through it."
Well, and it takes us back to deductions can't be lavish or extravagant.
Right.
Me as a single member S Corp, who is the board owner and the officer and the shareholder.
And the janitor.
Yeah. Should I be spending, I like the $14,000 figure. Should I be spending $14,000 to host my meeting? Probably not. I should probably take myself to Starbucks.
Right,
something along those lines. It's a little bit more reasonable.
Totally, I agree. And to qualify for a deduction, just in general, right, it has to be ordinary and necessary. Ordinary is something that everybody does in your industry. Okay, so I'm not sure how many board of director meetings are happening with CRNAs, let's say. And then necessary for your business to survive, right? And so ordinary and necessary are two just cornerstone rules, and then it can't be lavish or extravagant. So, so the home office, to kind of bring it all back, it's a wonderful tax deduction, but not necessarily for the home office itself, but for the extra deductions that opens up, and basically mileage, or if your car is owned by the S Corp, if you will, then all the gas and all the stuff is deductible. Let's talk about automobiles. Tell me about, someone calls you up and says, "Hey, should I put my car in, should a business own my car?" It's a loaded question,
As
right?
with all things, maybe.
Yeah, exactly. Yeah, we'll give you the qualified. Let's look into it.
Yeah. What kind of car are we talking about?
Right.
How many miles do you drive a year? And something that we see with CRNAs too, because this question is something they have all the time, but they're usually staying so close to the hospital that they're really not putting that many miles on their car, but their business use percentage is staying so high.
Right.
Because they're really using that car almost exclusively for work. Because they're staying 5 miles from the hospital. Maybe they can walk to the bars or restaurants, and who wants to drive back after doing that? So,
Find parking.
Yeah, so a lot of the times it might be better for them to take put the car in the name of their business so they can take a depreciation deduction, and then now they can swipe the business card when they're at the pump. Whereas if we're doing the standard mileage rate, which might make sense, you know, depending on your individual situation, if you're doing the standard mileage rate, all of those auto expenses have to be paid personally by you, and then you need to have the business reimburse you for the standard mileage rate.
Right. No, that's a problem. No, I agree. So 100%. There's two bookends, right? High miles, cheap car. High miles, let's say 20,000 miles. Cheap car being, let's say, 30,000. That's almost clearly one that you want to own individually and get reimbursed by the S Corp for mileage. Because there's tax arbitrage, right? What's the mileage rate?
62.5
60,
for the rest
well,
of
they
this
just went
year.
up, right? Because of...
Did it go all the way up to 62.5?
For the rest of this
From
year?
58, I think, for the first half.
So it went up, I know, July 1st. But anyway, so that's free money in a lot of ways, but on a cheaper car. A cheap car might only operate for like 40 cents a mile. And
you're Subaru.
Yeah, something like that, yeah. And it's efficient, it's not depreciating much and all those things. So the mileage is a tax arbitrage play because you can get all this extra, if you will, income from your business that's not taxed, or I should call it reimbursement, that's not taxed. That's cool. Expensive car, let's say $80,000, $90,000, $100,000 luxury car, and you're driving 8,000 miles. And also, let's say you turn cars over every 2 or 3 years. So you're already mentally prepared for the big drop in value right away. That's a car that if you can justify should be owned by the business. You know, it's the person who wants to spend 58,000 or 62,000 and they drive like 12,000 miles. You're like, it's probably half dozen one, 6 the other. Do you want to brag about it at the parties that your car is owned by the business, or do you really not care?
Do you want to use your business card at the pump?
Yeah, exactly. Yeah. It's all better convenience or what? So yeah, that's automobiles. Real quick sidebar on this stuff. We get a lot of phone calls in December like, hey, should I buy a car before 12/31 for the tax deduction? And we always say, do you need a car? Because we do not spend money for a tax deduction. That's insane. You spend money because it makes operational sense. If it happens to be a tax deduction, then great.
It's a write-off. Right?
Oh yeah, it's free money.
The write-off people pay for it.
Yeah. It's like Monopoly.
I've been trying to get a hold of those guys.
Yeah. I'm always in jail, you know, in the Monopoly board. I can never get a hold of them. So automobiles are great tax deductions because you already have that expense coming out of your person. You know, now let's find a business use for some of that and make it a deduction. So cell phone, internet, you want to talk about that a little bit, Megan?
Yeah, so I mean, there's hardly anybody who can do anything, you know, for their business without cell phone and internet at this point. And so we see a ton of people, they're basically utilizing their personal cell phone, their personal home internet connection to operate the business. That is at some level a business deduction.
Absolutely.
You should be taking a percentage of it. Now WCG says, slow your roll. We're not going to let you take 100% of all this stuff because you are getting some personal usage out of it too. But yeah, I mean, we see people who their internet connection is their, you know, the way the business communicates with the rest of the world.
Totally. Especially in CRNA land, it seems like they're looking at their cases, they're interfacing with the hospital, doing a lot of stuff just all on their cell phone. They're getting alerts about what is coming up next and all that. So yeah, we look at 80% as kind of like our max as a firm. We feel like there's always going to be a 20% component of, hey, honey, we need milk and eggs or something, or your kids call you or whatever. And then internet, we kind of have a similar concept, about 80% of that, up to 80%. It really depends on each client and all that. So yeah, cell phone, internet, and then so in those examples, in that home office, and let's assume automobile mileage is happening, so you're getting reimbursed for miles by the S Corp, by your entity, cell phone and internet, those four, right? We kind of categorize those as mixed use in a lot of ways. And let's just assume that the automobile is personal and business. We need you to pay for all those expenses personally and then get reimbursed by the company. I think it's a common misconception, like, hey, I'm driving to the hospital and I need gas to get to the hospital. I should pull up my business credit card. It's like, stop. If this car is both personal and business, we need you to pay it with personal funds and then have the business reimburse you for the business use of your car, which is typically going to be the mileage rate. So
yeah, and back to one of our previous segments, that just helps you with that arm's length transaction between you and the business. You know, you're so close to the business, but you know, I work at WCG. WCG isn't giving me their company card to fill up my tank, right? It wouldn't make any sense. I'd like it, but it wouldn't make sense. So,
but we are looking at giving you a cell phone, though.
That's true. That's true.
But you will reimburse my mileage if I go drive around for the company.
Yeah, so I pay for it with my card. I submit an expense reimbursement, and I don't know if accountable plan is on there too, but that's another really important document to have because normally reimbursements are seen as taxable income, unless you have an accountable plan in place.
Correct. Yep, I agree. So yeah, and those are a good example. Home office, automobiles, cell phone, internet's all accountable plan. Expenses, meaning if you don't have this document, it's very simple and we can draft it for you and all these things. You don't have this document, if asked for it, the IRS will then deem all those reimbursements as income. Which is not good because since the Tax Cuts and Jobs Act, you can't deduct any of that stuff against your ordinary income. So it's kind of a crummy deal. Let's talk about meals, right? All right. Yeah.
It's dinner time.
Yeah, we all grown.
We all having a meal here.
This is gonna be a long segment, everybody. Like I said, get that beer. If you need another, if you need another beer, go hit pause and get one. talk about meals, Megan, a little bit? Like,
yeah, so meals, and it goes back to this whole ordinary and necessary thing, right? And I'm going to forget the name of the case, but the guy who wanted to eat every single meal out and say it's a business expense, the IRS says, nice try.
Dr. Sutter, actually, a physician.
Sutter.
Yeah.
But, and it's like anything else. Don't be greedy, don't be unreasonable, and it's going to be fine, right? Your meals should be necessary. You should be eating with clients. You should be eating away from home, some of those things.
Yep.
So.
Yeah, so to kind of break it down, you can't, so let's just tell you what you can't do, right? You can't go to the hospital cafeteria and order lunch and get lunch and all that stuff and call that a business meal. It's not, right? You need to eat anyway. Now, if you happen to have a business meeting with another associate, let's say you're talking to a hospital administrator, you're talking to a fellow CRNA, you're comparing notes, you're kind of talking business, and everybody talks shop and business in a lot of ways. If that was a meeting that was already going to happen, and then you happen to eat during that meeting, 2 thumbs up.
Yeah.
Now that becomes deductible. And this is the last year, right, of 100%, right? Next year it goes back to 150%. Next year being 2023, if people are watching this like 100 years from now. So that is what you cannot do. You cannot just deduct every meal. It has to be a meal that just coincidentally happened during a business meeting. TDY meals, all bets are off there. Those are a 50% deductible all day long as you meet the TDY requirements, even if you're eating by yourself, right? Trying to think of what else we want to talk about with meals.
Travel meals, TDY aside too.
Right,
so if
going to
you're
that conference.
Yeah, so if you're not TDY, so I'm going to give Colorado examples, even though we do 80% of our business outside of Colorado, but I work in Denver, right? I'm in the Colorado Springs location today. Man, but driving back up to Denver, I'm going to get kind of hungry. I think I'm going to need to stop by Chick-fil-A.
Get a snack.
Sponsor me. I think I'm going to need to stop by Chick-fil-A, get a couple spicy chicken sandwiches, start chowing down on those, and then submit.
Is it just you in the car?
Yeah, it's just
2
me.
sandwiches.
Just me. It's a deduction. It's a write-off. It's a write-off. But no, you can only deduct travel meals if your travel requires substantial rest.
Right.
So 45 minutes from here to Denver, not substantial rest at all.
And taking a nap in a lounge or finding some random hospital bed to take a snooze in is not considered substantial rest.
Right.
Yeah.
But if I'm driving from here, maybe to Wyoming to meet a client, that's a little bit of a haul.
Right.
So then when I'm stopping there, getting a meal before I go back, then that would qualify as a travel meal.
Right. As long as you had that substantial rest. Yeah, exactly. So, so meals are a great deduction. We'll talk about putting spouse on payroll here in a second, because that kind of loops back to the meal stuff. How about education? A lot of people that are watching these videos have taken some classes. One of them is offered by Alicia Quante, and she does the 1099 Master Class, I think it's called.
Success Academy.
Yeah, Success Academy, yep. And that costs money, I'm sure. Alicia doesn't do it for free. She travels a lot, so I'm sure she's doing okay. Anyway, that education, business deduction?
It depends.
Yeah.
My favorite answer. Education is going to be deductible if it doesn't allow you to perform substantially different services in your business, right? So for a lot of our staff accountants, if they're not credentialed, they can't sign tax returns, right? So they're going to go out, they're going to get credentialed, they're going to spend a decent amount of money, we reimburse them for it, but they can't deduct those because now they can perform significantly different tasks here, but like continuing education, right? So all of the CPE credentials do, and all of the CPE CRNAs do, and traveling healthcare professionals, doesn't really allow you to perform significantly different tasks. It just allows you to keep doing your job. So that's 100% deductible.
It really comes back to that ordinary and necessary. This is necessary. I cannot stay licensed to do the job that I'm doing if I do not do this education.
Correct. Yeah, so with this particular class, the Success Academy offered by Alicia, I look at it as continuing education.
Yeah.
It's just additional education to improve your current work skills. Now, there are some really, I would say, bad tax court cases out there, and one of them involves a nurse who got this extra certification to do something, and allowed her, as a female in this situation, allowed her to do these other procedures and allowed her to get into other areas of the hospital. And the tax court came down on her like a ton of bricks saying, oh, no. This allows you to do other types of work, it's not deductible. So it has to improve your current work skills, not give you new work skills. Now, I think that's razor thin, you know?
Yeah, because we've also seen tax court cases where people are deducting their MBA.
Correct. And I've seen the exact same fact pattern in another court be denied.
Right.
So it's really squishy. WCG typically is going to presume to say yes, it's deductible unless it's very obviously not
Substantially
deductible.
different.
Yeah, just in general, like we're the client's advocate. Now, you know, at some point we say, no, that's clearly not deductible, and this clearly is. But if there's a question, if there's a fact pattern, if there's a situation, there's all those things, and it's not obvious that it's not deductible, then we're gonna probably go back to the client and go, what do you want to do? You know, we believe we have a reasonable argument. We might lose, but our argument's not unreasonable.
I wouldn't be embarrassed to make it.
Right, exactly. Yeah.
And that's being
I took
embarrassed.
this class.
Yeah.
Exactly. So.
Well, being embarrassed about the deductions is something I talk about with clients all the time too. You know, I ask them, like, if you and I are sitting across the table from an auditor, can you look at them with a straight face and say you spent $20,000 on meals? And
Right.
they were all a business expense,
Yeah.
and you know, they kind of start to see it with a different lens.
Yeah, exactly. And we can go on and on about that and about tax deductions and reasonableness and the risk and all those things. So let's kind of jump ahead. I got a tire on here. I don't want to spend any time on that. Let's talk about putting spouse on payroll. What do you guys think about that? There's two big advantages.
Yeah, well, the one that I always think of first is retirement.
Yeah, totally.
So, you know, now
And
that
specifically a 401k.
A 401k specifically, yeah, because now that I'm an employee of my business and I'm going to get a W-2, I can also defer money into a 401k. The maximum for me, the individual, is $20,500 for this year. Well, now if I put my spouse on the payroll, guess what?
Double down.
They also have a $20,500 deferral limit. So if you can cash flow it, you can get to a point. I mean, for a married couple, what would it be this year? $122,000. You could max out $61,000 each.
Yep.
If you max
It
out
takes
everybody's
big
comp.
salaries,
I mean,
right.
you have to have a lot of income to make that make sense. But the limits double for, you know, if you can put a spouse on payroll.
No, it's awesome. I mean, if you look at officer compensation, let's say of $100,000, you have a CRNA business. We have to think of it as a business. $100,000 officer comp, let's say. Let's say the CRNA business is making $250,000. We determine that $100,000's a reasonable salary. Using that as an example, yeah, you could pay somebody, let's say, $70,000, and then pay the spouse $30,000. Still combined for 100, so officer comp looks reasonable on the S Corp tax return, but now you're able to double down on those 401k contributions. You have to be a little bit careful if your spouse does work and they have another 401k at his or her job, then you have to make sure you don't violate those limits when combined. But yeah, 20,500 times 2 plus 25% of that W-2, combined W-2. So in that case, you got 20,500 times 2, that's 41,000 plus another 25,000. So you got $66,000 if I'm doing the math quickly. A 401k contribution, that's massive. Some people get cash limited. Like you start talking about these numbers, like, oh, well, I don't have that much. Okay, but that's available to you very easily with very little pain, right? Adding your spouse costs you about $400, let's say, on average, of additional unemployment taxes, and everything else is the same. There's no additional Medicare, or Social Security, or income taxes. It's just being shifted around. So
that's huge.
And any other benefit, or do you want to add something to that?
Go ahead.
The other benefit is it allows you to find ways to deduct things you're already spending.
So I want to go to a conference in Vegas and bring my spouse.
It sounds like she needs to be there for the business. Especially in a CRNA instance too, because CRNA's the last thing they want to do is administrative work. You know, they're at the hospital 12 hours. Some of them work 24-hour shifts. I don't know how they do that, but
Don't you work 24 hours doing tax returns?
In private, you know? So, you know, they're at the hospital for such a long time, and to come home and do bookkeeping or, you know, administrative tasks or even cleaning up their home office, things like that, just let your spouse take care of it.
Yeah, I agree, 100%. Awesome. Well, I agree with that. I want to just add on one more thing. In our previous segment, we talked about that temporary duty assignment stuff, right? And I want to make sure that our audience understands that is very much different than working 2 weeks on, 2 weeks off indefinitely. So there's a lot of CRNA jobs out there which are great, where you're sitting in Texas for 2 weeks off, and then you travel to Illinois for 2 weeks on, and you come back, and you're doing that indefinitely. Your tax home is in Illinois, not Texas. That travel, not deductible. Those meals, lodging, all that, not deductible. Now, if that assignment is 6 months, 9 months, definite, under a year, then maybe it's now a temporary duty assignment. So if you are finding yourself in that 2 week on, 2 week off situation, try to nail down the term, so then we can qualify that as a temporary duty assignment. So anyway, these have been great segments. In our first segment, way back when, we talked about the overview of the CRNA industry, why going from W-2 to 1099 is a good idea. Win-win, right? More money, more deductions, perfect. Basically more cash coming home, because you're making more and you pay less in taxes, right? Talked about the entity, S-corp election, when to defer, all that stuff. That sounds awesome. State issues, when to register, where you're going to pay income taxes, or you're going to have to process your payroll. We talked about temporary duty assignments, home office, accountable plan stuff like home office, automobile, cell phone, internet. We talked about meals, education. Is it improving a current work skill, or is it required for your continuing education, like your credential, like CPAs and stuff like that. We talked about putting spouse on payroll. We've only talked about a few things really in the last hour and a half that we've been doing this podcast and recording. So get a hold of us at WCG, talk to us. We do have a CRNA specialist team. We do a lot of CRNA stuff, and there's a lot of, I would argue that 70% of them are all pretty same. So kind of like a house. Your house has 4 walls and a roof, so does mine. But the inside of it's a little different, So everyone's going to have some uniqueness, and we can certainly help navigate through all that. Again, my name is Jason Watson with WCG.
I'm Joseph Bassett.
Megan Oeltjenbruns.
And this has been our podcast, our 4-segment podcast on CRNAs. One of the things that we, I think, intentionally avoided was reasonable compensation. And that's probably another 5 or 6 segment podcast, because there is no good answer on that. So stay tuned for the reasonable compensation podcast. We'll get that recorded pretty quick here. And we thank you for your time.